Hey guys, this is Alex from Solutioninn. Today it is our first lecture and we are going to talk on interest. Many students have questions about that, so we are going to make them all clear. What is interest? By definition, it is something that is paid in excess of a principal. The real reason behind is a complete philosophy and a mechanism. The interest is sometimes termed as a rent for using the money. That's quite okay. So sometimes it is said that I have no interest in this, and this statement is apparently very general. Now try to feel that the sense that a person has nothing in the excess. Now look at the real world scenario. Suppose that you want to start a business and you need round about $20,000, but you don't have it. What would you do then? You will find an alternative and go to bank and ask for a loan. Have you considered that? Why would bank give you that? Bank will give you a loan on basis of interest. Suppose if you want to get loan of $20,000, but the bank will give you $20,000 on 5% of interest. So that is something that bank is earning. This is the profit that bank will earn from you on basis of $20,000. So you have to consider it. There are two types of interest. The first one is simple interest, and the second one is the compound interest. Talk on simple interest. What is simple interest and what are the basis of it? Simple interest is the amount that you will have to pay on your principal amount after each period of time throughout your long term. Consider you borrowed $5,000 for 5 years from a bank on 2% of simple interest basis. Now your interest after 1 year will be $100, and based on 2% of the principal amount, that is $5,000, that you will pay to your bank after 1 year. Similarly, you will pay $100 of interest to bank after second year, and the same amount on the third year and fourth year. And on fifth year, your interest will be $100 and the principal amount will be $5,000, and you will make your final payment equals to $5,100. Let's talk on compound interest. What is compound interest? It is the amount that you will have to pay at the end of loan term on principal amount plus any interest on principal amount added after each period and throughout the loan term. Consider you borrowed around about $5,000 for 5 years from a bank on 2% of compound interest annually. Now your interest after 1 year will be $100 based on 2% of principal amount, which is $5,000. Same as in the case of simple interest, but the difference is that it will not be paid, rather it will be accumulated and become the part of principal amount for next year, making it equals to $5,100. Now come to next year, in which interest will be calculated based on new principal, that is $5,100 multiplied by 2%, which equals to $102. And this amount will be added in principal at the end of year 1 to find out the principal at the end of year 2, making it equal to $5,202, and that is equal to $5,100 plus $102 that is calculated. So for calculating the value accumulated at the end of year 5, we simply multiply the principal amount with the compounding factor that is denoted by total amount after 5 years, which is equal to 5,000 into 1 plus 2% raised to power 5. That equals to $5,520. So we know about interest, and now we are going to discuss on finance and capital markets. Finance means funds, money, wealth, etc. Whenever anyone needs these things, they either go to financial institution like bank. The financial institution like banks, exchanges, financial intermediaries, private agencies collectively are called capital markets. There are two types of financial markets. One is debt security market and the other one is equity security market. Let us discuss debt security market. Instruments like bonds or debentures are debt security markets. Debt security markets are closely related. Let's see how. Let's talk about interest and debt. Interest has already explained that our excess payment paid on amount loaned. That means obligation or responsibility to pay. Having a debt means you owe someone money or anything else. Having a debt means that you are liable to pay someone. Whenever there is a debt, there is always an interest payment attached to it. That responds the principal amount and any interest payable on the principal. Guys, kindly like and subscribe to our channel.